To see you. Thanks for spending time with us here today.
Of course.
As we discussed stock compensation planning, something we've seen more from new clients of ours. I think it's something that we're seeing more of just by companies in general. So just by way of background, Susan, you're a certified public accountant and a partner at Albert Tucker, as I mentioned before. Who are the types of clients that you're working with and servicing?
Honestly, it really runs the gamut. We certainly have a significant number of clients who are in the financial services industry, given we are based in New York. But honestly, we've got a lot of small business owner clients. We've got a number of clients who work for emerging tech companies, you name it. Honestly, we don't have any one niche market. It's more individuals whose situations are becoming more complicated and they've outgrown using TurboTax or, using your mom and pop shop because their tax returns have gotten more complex.
Great. Well, I know you're not new to the stock compensation planning realm, and you see it from a tax standpoint. So, happy to have you here, and happy to have you share some insights specifically on the tax ramifications of stock compensation planning. So, the agenda today is to really go through restricted stock units, non-qualified stock options, as well as incentive stock options. First of all, what are they? What are the taxes associated with those grants, the vesting and the exercising? And we're also going to talk about a few mistakes and some key considerations. So with that, we'll get started and work our way through the PowerPoint here. So we're going to first start with restricted stock units, which really is a form of compensation where employees are going to be granted shares of their company. Why is this done? Well, I think the hope from the company is that the employee is going to work hard and be a good steward of the company to move that company stock price forward and thus benefit the employee themselves as they receive those shares. The vesting period, so restricted stocks will vest to the employee. Typically, that's going to be time-based or it's going to be performance-based. So time-based would be, say, a 3-year vest, in which case shares would vest over a period of the next 3 years, and that would be contingent upon employment. Or it could be performance-based, which would be tied to certain achievements or certain corporate goals where those shares would then vest. So as we mentioned, vesting with restricted stock units, Susan, why don't you take this one and talk about when that vest occurs, what are those employees going to be looking at from a taxation standpoint?
Yes, this is a commonly overlooked compensation event. Depending on the fair market value of those shares on the vesting date, that will equate to W-2 compensation. So if the shares are valued at $100, you will be taxed on that $100 value of the shares on the vesting. What typically will happen behind the scenes, employers will withhold a portion of those shares that have vested to cover your taxes. The common misconception is that your taxes will be fully covered by the shares that are withheld. Unfortunately, for most people, the withholding is a little insufficient to fully cover your federal tax obligation on the value of those vested shares. So it's something we are consistently involved with clients for modeling out their compensation for the year and determining the exact amount of under withholding on the RSUs that are vesting so that you've got visibility and can potentially submit quarterly estimated tax payment to ensure that you're covered.
Yeah, and that could be a potentially large issue if these restricted stock units vest at a considerable amount or dollar value. If their withholding is, say, 20% or 22%, yet that client is in, say, a 35% tax bracket, there's a pretty big gap there. What are some solutions to that? Obviously, you want to plan, you want to be aware of that. What would you be advising as a CPA if a particular employee, has only a small percentage of their taxable income withheld?
So it depends, to be honest, on their personal objective for the remaining shares that they're retained. If you feel confident about the company as a whole and you want to hang on to those shares long enough to realize long-term capital gains treatment, then you'll have to come up with another way of funding quarterly estimated tax payments. In a year where RSU represents a pretty significant portion of your compensation, you may actually be in a position where you have already met your safe harbor requirements, even via the insufficient withholding that's taken place, in which case you can potentially kick the can down the road until the following April to true up the remaining taxes. That being said, it's important to model this out and know what's coming down the pipeline. So if you have a major liquidity need in April of the following year, you're prepared for it and can plan for, either savings objectives personally or for liquidating of certain investments in time to pay the remaining tax liabilities.
That's great. Super helpful. So again, there's no difference really in the taxation of an RSU that vest or a cash bonus. The difference is that stock could appreciate in value from the time it's granted to the employee, right? The could be granted $10,000 of equivalent shares that appreciate to, say, $25,000 of equivalent shares. When those shares vest, all of that is going to be taxed as income to the employee, where if it was a cash bonus, right, you have that 10,000 is going to remain 10,000 in terms of the net back to the individual employee. So we kind of think that RSUs are really a cash bonus. It's in the form of stock, which can be positive and negative. It's a moving target depending upon the value of the company and what has transpired from the grant date to the vest date, because it all matters. When that stock vests, that is going to be the taxable event. And there's really no changing that or no deferral of that. Oftentimes RSUs are going to be used as a retention tool. So the receipt of the shares, the vesting of the restricted stock units is typically contingent upon employment with the company. Now, if you leave the company, you could be forfeiting those shares. There are a few exceptions, retirement and possibly being let go. We've seen some areas where companies will still allow the vesting to occur. Sometimes there'll be an immediate vest, and it could be on a pro rata basis. But if you're leaving the company to go to another company, you're going to be leaving those unvested shares behind. So something to keep in mind. We're going to work through an example here, and as we kind of go through this example is an employee's granted 600 shares of ABC company with a 3-year vesting requirement in May of every year, May of each year rather. So in year one, a third of those shares are going to vest, or 200 shares will vest, say May 15th. And at that time, ABC company is trading at $70 per share. Now, this is important and something that is commonly not, I think tracked or employees are aware of. But see here, 44 shares will actually be withheld for tax purposes. As we mentioned before, 22% would be a common number. So even though that employee received 200 shares or 200 shares vested, only 156 shares will be placed into that employee's brokerage account, where that cost basis is going to be $70 a share, which is the trading price of the stock that particular day. We've even ran into potential clients and prospective clients that didn't even know that brokerage account was set up on their behalf. So many times financial institutions, ABC company might work with Morgan Stanley. Morgan Stanley will create a brokerage account for the employee to have those shares vest into. So what we want to put on everyone's radar is be aware of that brokerage account, but also the 1099 and any tax documents that are going to be provided are coming from that, right? So now if you have assets at Fidelity, but your shares vest at Morgan Stanley, you want to make sure you get the Morgan Stanley tax documents to your CPA, or if you're doing your taxes on your own, account for that. So that's another, I think, helpful hint is you might have a brokerage account set up. You want to make sure that you include that with your tax documents. So Susan, when that occurs, as we see here, the taxable income is 200 shares at $70, not the 156. So I'm not sure if you have comments or anything to add there.
So yeah, I think you brought up a really good point. Number one, about the 1099 piece. There typically will be a 1099-B issued that reflects the sale of these shares to cover the withholding taxes. And a lot of people forget about that and will neglect to include it on their tax returns, and will eventually receive notice from the government saying you've omitted, gross sales of this security. And it's more of a pain than anything else, because largely it should be a wash the day that those shares are sold to cover. In terms of the withholding percentages, in most cases, you'll be over withheld for your applicable state income taxes and will be under withheld for federal income tax. It's a wonky system. Most people are like, why don't they just withhold the appropriate amount? Your guess is as good as mine. I think the overriding factor here is the goal is to retain more of the shares for the potential future growth and value of those shares. But with the caveat being, hey, if the shares don't increase in value or you're not planning for those tax liabilities, you can be left in a kind of unfortunate tax situation.
Yes, and it could be a surprise come tax day, right? That you have to write a sizable check because you had a large RSU vest, or other taxes could be associated with capital gains. And we're going through a couple examples here. So if that employee the very next day sells the stock, sells the 156 shares, but ABC company has risen from $70 a share to 72, that $2 gain per share is going to be taxed as a capital gain. And as we might be aware, if you have a capital gain on the sale of stock that you've owned for less than a year, that is going to be taxed as ordinary income. However, if that employee decides to hold the shares or a portion of their shares for whatever reason, in this case, the employee sells 156 shares 1 year and 1 day after, and the stock is trading at, say, 72, just to keep the math simple, now there's a $2 long-term capital gain, which is going to be either taxed at 0, 15, or 20%. So just, I know, fairly easy, Susan, why would it be 0? Why would it be 15? Why could it be 20% for the long-term capital gain? Because we see a pretty sizable difference here. If we're looking at the example of an employee in a 32% tax bracket, a $99 tax, compared to a less than 50% tax if it were taxed at 15%. So maybe just touch on capital gain treatments being 0, 15, or 20. What is that based on?
Yeah, so every year the IRS sets income ranges that equate to certain long-term capital gain and or qualified dividend income tax rates. Depending on what your income is in the particular year that you are realizing capital gains, will determine whether they are subject to 0%, long-term capital gains rates, 15%, or at maximum 23.8% if we include the additional investment tax that will kick in for higher earnings. So that's something to be mindful of if you have a year where perhaps a bonus is not paid and therefore your income level may place you in the 15% long-term capital bracket rather than that 23.8% bracket. Probably a good year to realize some gain. You'll have some meaningful federal income tax savings in that.
Great. Yep. So ordinary income when the stock vests. Now you own the stock. It's completely your choice what you choose to do. Sell the stock immediately, sell the stock in the future, but you will be subject to capital gains if there's appreciation. The negative could be, what if there's depreciation? What if the stock doesn't do well? Right? You are paying taxes on $14,000, but if the stock drops in value and you sell, you could be taking a capital loss. Very different than if it's a cash bonus, right? The cash bonus flows to you, it hits the bank account. Here, stock is going to hit the brokerage account, and it's going to fluctuate depending upon whatever that company price and stock does. So as we move along, certain thought process or investment strategies kind of come to mind, or conversations we have with clients. Number one is, think about this question. If your employer were to hand you a cash bonus, would you turn around and use it all to purchase your company stock? Because that's really what's taking place. If the answer is no, then you might want to think about selling all or most of those shares and possibly investing that into a more diversified portfolio, hopefully in probably lower risk, more consistent returns. But that's what's taking place. You don't have a choice in the matter. All of that comp in the RSU is going to vest as company stock and then is going to move as that company stock moves forward. The other thought process is, what if you already have vested shares that have appreciated in value? This is very common for employees that have been with the company for several years that have been granted RSUs that have now vested over a period of time. I like to make the analogy, it's like you're at an airport and the RSUs are airplanes, right? And they keep hitting the runway. If you're not doing anything, you're just going to see that continue to pile up. So you're going to have different prices. You're going to have the company stock and the brokerage account, but you might have several years of different cost basis. You might have some considerable appreciation if we're talking about technology companies or just many companies over the last several years where the market's done well. Many individuals might feel that the taxes are now a barrier to diversifying, right? And no one wants to pay any more taxes than they need to, but we often talk about the opportunity cost. Could that money be utilized elsewhere? Maybe for appreciation and for growth, but it also could be utilized in other investment assets. So one thing is you could sell those vested shares. You now are turning that stock into cash and use it to fund an IRA. That possibly could be a backdoor Roth conversion. Now you have wealth in a Roth IRA that will grow tax-free theoretically forever. If you're not maxing your 401k plan, you could sell vested shares. Yes, pay some capital gains, but now give yourself the ability to increase your deferral into the 401k and maximize your 401k, which might also allow you to get the full company match. You could also fund a health savings account, which is really the only triple tax-free savings vehicle out there. Health savings accounts are a deferral into the health savings account, tax-free growth, and then a tax-free distribution if it's used for health purposes. And for individuals that have children, you could use that to fund a 529, which is actually pretty common for many of our clients that have younger children. They're having an RSU vest, or maybe they've had vested shares over previous years. We're using that as kind of the seed money to make 529 contributions. Susan, any comments on that in terms of just what you've seen over the years and the RSUs that over a period of time build up in value? The positive could be that the stock appreciates, but many times we see people paralyzed by selling just because they don't want to pay capital gains.
Mm-hmm. Well, and these are all great examples of other ways to be using some of those funds. And if you're hesitant to, say, sell off some of your shares you've had for years because there may be a significant amount of appreciation within those shares, but you continue to have shares vesting, then it might be the time to strategically say, okay, any additional shares that I vest, I am going to immediately sell off for liquidity needs. There's no additional taxable income if we're talking about executing on a trade essentially same day. Oftentimes we'll see people get into this sort of even harder position where they may liquidate a month or two later. You're paying at ordinary income tax rates on any appreciation in the interim period. You're not benefiting from the long-term capital gains rate. So if you're planning to liquidate in the nearer term future, you may as well do so pretty concurrently with the vesting dates. I think these are all great examples of ways to utilize those funds in a more tax advantage fashion, and to avoid from accumulating too heavily in one particular position.
Yeah, you actually bring up a point, which is a recommendation we make to many clients that have vested shares over previous years, is to now, when new RSUs vest this calendar year, to really be aware of that date, to sign in and look to sell that possibly the very next day. And in the event of the previous example, if the stock vested on Monday at $70 and then on Tuesday it's trading at $70 or even $69.80, something close, an immediate sale is really going to result in minimal or no additional taxes. And what we've just done is we've now changed that stock bonus into a cash bonus that could be utilized to now diversify or for other potential objectives, as we mentioned before. So I think that wraps up restricted stock units, which is the most common form of stock compensation that we see out there. Next, we're going to move on to non-qualified stock options. Easiest way to think about this, these are essentially the ability that allow employees the opportunity to purchase company stock at a specific price, and that's the key point there. Many times employees might need to be vested into this option, but let's talk about the taxes associated with the non-qualified stock options. Does it occur when it vests? Or as you see here, this is going to occur when you exercise. So maybe talk about the difference between vesting versus exercising with the non-qualified stock options, and then what that tax is.
So yeah, I mean, that's the key distinction here. This isn't just going to automatically happen behind the scenes the way that the RSU vesting will. For the non-qualified stock options, an individual drives the bus on when they want to exercise, if they want to exercise. It may not be worthwhile if it's going to result in a pretty massive tax bill, or if you don't feel particularly confident in the future performance of a given entity. Typically, you'll only see taxpayers exercise their non-qualified options if they are significantly in the money, is how we refer to it, which basically just means if your strike price is below the current trading price. At that point in time, you will pay tax on the spread between your strike price and the current fair market value of those shares. So if there is a significant difference between the two numbers, great, it's a pretty savvy investment. You know, you're doing well already, but you are paying tax and ordinary income tax on that spread, which can mean a significant liability, and it's something that you want to be prepared for, particularly if there are restrictions on your ability to sell those shares. Mm-hmm. As that can leave you in a position where, okay, you need some liquidity to cover your tax liability, but you have potential blackout windows where you cannot sell those shares that you executed your options for. So you want to be mindful of that.
Yep. The key word is control. So with a non-qualified stock option, the employee has the control on when they exercise, which means they control the income tax. With a restricted stock unit, the employee does not have the control. The stock is going to vest, and there's going to be the income tax at that point in time. So that's the key distinction here. There's three common forms of exercising. Number one, to exercise a non-qualified stock option, you can do what's known as an exercise and hold, which means you pay cash, right? You utilize funds that you have saved and you buy the stock at that set price. Again, we're only going to do this if the stock price that is higher, is currently trading at a price higher than what you were initially granted those shares, because you have a guaranteed gain built into that. And then in turn, you're going to receive the shares of the stock. Another common way of exercising is what's known as exercise and sell, or commonly a cashless exercise. Here, employee is paying in cash from the sale of stock proceeds, meaning that you don't need to save money or liquidate investments elsewhere to come up with the cash to buy the stock. Instead, they're going to do that with the stock sale proceeds, and then in turn, you're going to receive cash. You're going to do an exercise and sell. So you're going to exercise the options, turn around, sell them right away, and kind of transitioning a stock option into a cash bonus. Then the third option is to pay in cash, again, from stock sale proceeds. So that could be 100 shares you decide to exercise, but you might need to sell 20 of those shares to pay the taxes associated with the option, as well as the cost of that option as well. And in turn, you're going to receive shares of company stock. So use cash from the actual sale to cover and then receive shares of ABC company. So let's go through an example, because I think that's helpful to kind of work our way or think through this. So in this scenario, 1,000 shares of ABC company, it's a 4-year vesting period. So what that would mean is 250 shares will vest each year for the next 4 years. The exercise price is $75, And then commonly we're seeing 8 and 10-year expiration. So you got a long time to make this decision in terms of exercising the option. You also have a long period of time that if the stock is currently trading under the grant price, for that stock to appreciate in value and turn that option into a actual viable income strategy for you. So in this scenario, 250 shares vest. You would only exercise if the stock is higher than 75. Again, it doesn't make sense to buy the stock at 70. Buy it at 75 if it's trading at $70 a share. So in this scenario, the stock is now at 80. You decide to exercise your right to purchase the stock at 75, and now the spread is $5. So from a visual perspective here, this strike price in blue is going to remain at 75. The employee has the right to buy the stock at 75. Will do so only if the green line trends, right? If the stock is driving up in value. And in this scenario, the employee decides to exercise when the stock is trading at 80. This spread here of $5 is taxed as income. Let's talk about cost basis. So Susan, why don't you walk us through the cost basis? If the employee goes ahead, stock's trading at 80, they have an exercise price at 75, they want to kind of cash in that option, they go ahead and do so. When the dust settles, what's the price of their stock moving forward?
Yep. And this is commonly not reported in the most clear fashion at the end of the day. You'll see at the end of the year, most W-2s will have some reference to the fact that non-qualified options were exercised and baked into your W-2 compensation to the extent of that spread. If you then turn around and sell those shares, your adjusted cost basis is actually whatever the fair market value was on the date you exercise those shares. Many 1099 forms may not include your adjusted cost basis. It may not be included at all on the 1099-B, it have missing cost basis, or it may report your strike price, but not what you already paid tax on, which is the full fair market value. So you want to be mindful of that and make sure that you're seeking out what typically is referred to as the supplemental statement for your 1099-B, which will include your adjusted basis that essentially just reflects anything that was included as W-2 compensation in stepping up your cost basis to get the true calculation of any additional gain upon selling the shares.
Great. Super helpful, very in-depth. There's a lot to this. As we mentioned here, be careful. Some financial institutions may not automatically update the cost basis to $80. What that means is when you then go to file, the assumption is going to be sometimes 0, and you need to self-report or do a lot of digging back into previous exercises to determine the stock price. Many times this is done for you, which is great. But the key is you want, after you exercise the option, just follow back up and see if the cost basis has been updated to reflect the price at the stock when the exercise occurred. Again, this is all very positive, right? This is a lottery ticket that you're deciding to cash in. The stock is trading at 80. You have the right to buy it at 75. That's phenomenal. And you got typically 8 to 10 years to make that decision. So a great form of additional compensation. Some key things to think about would be taxes. When do you exercise? When do you take advantage of that lottery ticket, so to speak? Well, certainly if you think the stock is going to drop, you want to lock in that gain and go ahead and exercise those shares. That's number one. Number two, maybe you're leaving the company. You don't want to leave these shares on the table. Go ahead and exercise and sell them because it's compensation that you earned while you're at the current employer. When you leave, you're foregoing those options. Also, maybe your income is going to increase, or just in general, taxes are increasing. Taxes could increase next year because of your compensation. Maybe you're getting a raise, a large bonus, or a large RSU is vesting next year. If you're in a lower tax bracket this year, this is the year to think about exercising some options. We don't know, but as it stands right now, all tax rates are set to increase in 2026. So possibly these next few years are opportunistic to exercise options because, again, you're doing so and paying less taxes. If your taxable income is less now than it will be in the future, you might want to think about exercising your options. Great. So move along to the last piece here, incentive stock options. These are not as common, but can be very, very lucrative and very special. They're commonly seen with smaller companies, newer companies, but we're going to work through another example. So the key difference here is the tax on the spread. So it's the ability for that spread, the exercise price relative to the current trading price, if done correctly. An incentive stock options tax on that spread could be taxed as a capital gain rather than income. There's some requirements. The common term here is you need to meet the qualifying disposition. Susan, I'm going to let you run with that one, as that can be a little bit complex. So on a high level, as best as you can, walk us through the requirements for a qualifying disposition and how that could potentially trigger AMT, which is something no one's looking forward to.
Yeah, so definitely AMT is this sort of nebulous term that everybody's afraid of. Typically, our overriding directive as it relates to incentive stock options is to exercise early and often. Because typically, if you're exercising early in the life cycle of an entity, the fair market value of the shares will be lower. When you initially exercise ISOs, you do not have any regular tax implications. You only potentially have an adjustment for alternative minimum tax calculation. And that adjustment is equivalent to the spread between your strike price when you exercise the ISOs and the fair market value of those shares at the time. In many cases, if you exercise really early, your strike price may be pennies per share, and the fair market value may be an equivalent amount, in which case there is zero tax implication at the time of exercise. And all you're doing is starting the clock for your holding period of those ISOs. And as long as you hold them for at least 1 year from exercising the shares and at least 2 years from your original ISO grant, then upon sale of these shares, you will have long-term capital gain treatment on the entirety. And that can be a very valuable planning tool. The converse situation is, perhaps you feel really strongly about your company and you are exercising a little bit further along in the life cycle. In that scenario, the fair market value of the shares may be greater than your strike price. There's still zero regular federal or state tax implications, but you will now pick up an alternative minimum tax adjustment equivalent to the difference between your strike price and the fair market value. So if your strike price is $1 per share, it's currently trading at $10 per share, or the fair market valuation is $10 per share, then you've got a $9 alternative minimum tax adjustment multiplied by the number of shares that you exercise. So if you're exercising a significant number of shares, this may trigger alternative liability, which is something, again, you want to have modeled out for you in advance of choosing to exercise these options, because you don't want this liability to come up as a surprise when you go to prepare your returns, particularly if you're not able to then sell off these shares at that point in time, but you're saddled with this massive tax.
Right. Yeah. I mean, there's a lot there. It's very complex. I think the takeaway is, if you have a very significant spread, which sometimes is not uncommon with an incentive stock option, you need to do some planning, some tax. I think, would you do some tax proposals and run through an estimate to see if you're going to trigger AMT or not, and likely want to utilize the help of a professional there, so you know what you're doing, the tax implications, so you're not hit with an underpayment penalty, et cetera, because these can be very lucrative depending upon appreciation. And we'll work through an example or a quick one here. So in this scenario, 1,000 shares, ABC, 4-year vesting period. Now that it's a $5 exercise price, right? So the ISO was granted at $5 a share. It's a 10-year expiration. The stock's trading at $12, say a year later. The employee decides to exercise, and now they want to exercise and hold the shares. Why? Because they want to start that 1-year clock. Again, there's no tax, but that $7 per share would be the AMT preference item. Imagine if this was 50 cents. Now you have a much more significant spread on those number of shares, something that might trigger AMT depending upon the other income that that particular employee has. But here's the key. If you meet 2 years from grant, 1 year from exercise, and then decide to sell the stock, say when it's trading at $25 per share, right? You're buying the stock at 5. It's trading at 25. That spread is not taxed as income, which what would be the case if it was a non-qualified stock option. Instead, this is taxed as a long-term capital gain, which could be 15% or 20%, depending upon that particular employee's income. So that is a tremendous advantage. So from a visual perspective, think options, right? So here we have the strike price, which is going to stay consistent over the life of the option. The stock is trading in value. That spread, when it's exercised, and if it's a non-qualified stock option, this spread is going to be taxed as income. However, incentive stock option, if you're meeting those requirements and it's a qualifying disposition, that spread can now be taxed as capital gains. The result could be more than 50% less taxes associated with that exercise. So a huge, huge opportunity and a big difference between the two if you know what you're doing and you're meeting that criteria and you happen to have a stock that appreciates in value and gives you the opportunity to take advantage of that stock option. Anything to add there, Susan?
I think that was a really good summary of it. And again, I think with the AMT calculations, just because there is a spread between your strike price and current fair market value doesn't mean you shouldn't exercise these shares. I mean, you can still have fairly sizable AMT preference items and potentially still avoid alternative minimum taxes, which is why good to plan accordingly and work with an accountant to determine what is my tipping point. If I only exercise 500 shares, am I beneath any sort of additional tax liability being triggered versus if I exercise 1,000, I definitely have some additional tax liability. The other point to make there is if there is a spread between the two and you do incur some alternative minimum tax liability, it actually becomes a preference item down the road when you sell those shares. Your cost basis for AMT purposes is stepped up to whatever the fair market value was at the time that you exercised. So then there's sort of two parallel calculations going on down the road when you do ultimately sell those ISOs.
Right. So more cost basis awareness, possibly some more cost basis work. But again, putting in that effort, working with professionals, getting this done correctly could result in you not paying taxes that you otherwise would do if you weren't aware of what you were doing, didn't know how to or when to step up cost basis, et cetera. So we're wrapping up here. We're going to finish with a few key mistakes and some considerations. So first, the biggest one is just not understanding your grant or how it works. I think, unfortunately, the employers and the financial institutions that are holding these options are struggling with the education, which is in part why we're having this discussion today to kind of break it down. What do we see? We see 15, 20-page white papers about it, which is going to be very difficult to fully interpret because, as you saw today, there's a lot of moving parts if you happen to be an employee that receives 2 of the 3 forms of compensation. So the number one is understanding what your grant is, how it works. And then along with that is you want to understand the taxes, and you want to maybe think about not letting taxes drive all of the decisions. It's one thing to pay taxes. It's another to lose an opportunity or lose considerable wealth by holding on to something too long or not taking advantage of it. The other key mistake, you forfeit your grant in a job termination. You're not planning ahead and you're not aware that you're giving that up. Sometimes individuals have a hard time distinguishing an unvested RSU versus a vested RSU. The unvested, for planning purposes, we don't count as part of their net worth when we're doing financial planning because they don't own those shares. It's contingent upon continued employment. So just be aware of that if you're looking at changing jobs. Now, on that front, changing jobs, you could use that as leverage when you're having discussions with another potential employer, making that part of your compensation. Hey, if I leave, be aware, I'm walking away from compensation of X and Y if I just continue to stay employed with that company. That might help you in the form of a signing bonus or receiving stock options at the new company. So keep that in mind from a negotiation standpoint. Not having a strategic plan for the shares, I think we continue to talk about that. You want to have a plan for those shares once they vest. That's the biggest thing. What am I doing and why? And then lastly, unfortunately, we've seen getting bad advice on the financial or the tax planning side, not working with someone or getting advice from someone who's not well versed and doesn't work with stock compensation plans on a regular basis. So there are some key considerations as we wrap up. Susan, you touched on this a little bit, the wash sale, something to be aware of where you sell stock at a loss and you can utilize that loss to offset gains. So many times the wash sale, people just associate with buying and selling stocks. The wash sale can be a triggering event if you sell vested shares that might be at a loss. But if you do so and then exercise an option, or you have another stock vest within 30 days, it's going to cancel out that loss. You're not going to be allowed to take that stock loss that you might have thought you were utilizing to offset a gain somewhere else in your portfolio. So be aware of the wash sale. Blackout dates. Susan, why don't you take this one? What are blackout dates and why is that a key consideration?
Yeah, so depending on your plan and your employer, there may be very particular blackout dates during the year where you are not allowed to sell your company shares. And this can be incredibly hindering if you have a big tax deadline coming up where you need liquidity, whether it's your fourth quarter estimated tax installment that comes due in January of the following year. That tends to be a big true up payment, or the standard tax deadline, your April deadline, where you may have a large tax bill due because of RSUs vesting or because of other options that you've exercised during the year. If this falls within a blackout window and you cannot sell any of your company shares to pay for your tax liability, that may put you in a tough position because interest and penalties will begin to accrue on any unpaid tax liabilities after the filing deadline. So we want to be mindful of that. If you know that a larger tax payment is coming due, making sure that you're liquidating in advance of that tax filing deadline and within the windows that you're able to.
Exactly. Another issue with blackout dates is you can't sell the stock. What if the stock is appreciating significantly or depreciating significantly? What if there's an economic event and it's the end of the year? And in this country, right, we know that tax legislation is usually passed in the 11th hour. You're in a blackout date and there's tax legislation that increases taxes next year and you can't exercise that option, or the stock is dropping in value and you want to exercise and sell and kind of utilize the fact that you have a gain there. The blackout date would prevent you. So it's something to be aware of and certainly consider and try to plan around as best as you can. Another, just consider, what are you going to use this for? Is this for spending money? There's an upcoming expense like a car or a home improvement, something along that nature. Are you utilizing these shares to fund your lifestyle? Would you look to diversify and invest because you already have a considerable exposure to the company in the form of your employment, but also maybe continued future stock option grants and RSU grants? Maybe you do want to participate in the growth of your company. You believe in your company, you're a new employee. If you want to exercise and hold or not sell the RSUs, that's completely your choice. I think the consideration is just to think about that and kind of know what you're doing and why. And then taxes have to be a consideration when you're factoring in stock compensation. And then lastly, we're going to end with this. We continue to talk about it. Have a plan. Far often we see individuals that don't have a plan, so nothing happens, meaning stocks are not exercised, ISOs are not going through the qualifying disposition, so clients are exercising incentive stock options and selling, and paying ordinary income, where they could be putting themselves in a position to pay capital gain income or capital gain taxes. So have a plan. Know your compensation plan. Know what the taxes are. That's all going to help with those thoughts and considerations. And then utilize a professional to kind of talk through that if you need help. So with that, hopefully this was educational. Hopefully you have a better sense of the taxes associated with different forms of stock compensation. I think we're only going to see more of this. More stock compensation is going to be provided. It's a great job market, so employers are looking to provide incentive to attract employees and keep employees. So as this becomes more prevalent, you want to have a better understanding. Susan, thanks a lot for spending 45 minutes with us here and going through what can be very complex. So thanks again for your insights. And hopefully everyone found this helpful. With that, have a good rest of the day. Thank you, everyone.